Um, Hello, welcome back to the continuing lecture series in investments. Um, this is Dr. Jeff Hong, and this is video number 25, and this will be the final video in the equity valuation topic. Now, finally, we are at the last topic or last section of this topic, and it is, how to um, forecast or project the aggregate stock market, right? And also, this is related to a P ratio. Now, forecasting the aggregate stock market will use, earnings multiplier uh, applied at aggregate level. In other words, instead of a single stock, uh, you apply P ratio at aggregate level. So aggregate level means the entire stock market, right? How do you then how do you apply it to the entire stock market? I mean, but from Finance 100, we already know uh, the market is represented by S&P 500. Of course, S&P 500, you might say, is not really the broad uh, market index. I mean, there's Russell 3000, 5000. And to be really to represent the entire financial market, it shouldn't be only stocks. There should be, it should include also, the bond market, real estate, commodities, um, a lot of, you know, a lot of things as a broad uh, representation of the financial market. But since we are, dealing with, since we are dealing with the stocks, and uh, although there is something like Russell, 3000, S&P 500, it has been, empirically, and it has been used, as a uh, proxy for broad market. Because this, and we don't have to go back and go over this again. These 500 companies, represented in the S&P 500. It's pretty much the leader in their own sector, right? Their own industrial sector. So they pretty much represent the cross section of the economy. So using S&P 500 index as, price in P ratio, right? That's, what usually, is. So a forecast corporate profits for period, we can, and the idea behind, the idea behind it is not necessarily a single company, right? So what it says, forecast corporate profits for period, quarterly or annually, right? Or using the, using S&P 500 as the proxy for corporate, we will use change in market index as a proxy for change in corporate corporate profits, because that would pretty much capture the 500 companies, profits, changes in profits uh, of these 500 companies, which kind of proxies the entire economy. Now, so we need to derive estimate of aggregate P ratio based on long-term interest rates. Yes, um, there is like 10-year Treasury note, yield on 10-year Treasury note. It's a well-known fact that there is uh, a correlation between 10-year and positive correlation, of course, 10-year Treasury note, yield on 10-year Treasury note, and the uh, market, uh, general market, right? So let's take a look at this graph. The red line is Treasury yield, and the blue line is the earnings yield of S&P 500, companies in S&P 500. What is earnings yield? We already talked about this. P ratio inverse, the reciprocal of P ratio is the earnings yield. So um, earnings yield is nothing but a reciprocal of the price earnings ratio. So it's like earnings price ratio, right? And yield to maturity and current yield on a 10-year Treasury note, and earnings yield on S&P uh, and yield to maturity on Treasury notes move in tandem. Okay, and we just saw that evidence. So maybe it's better that I move, yeah, right after this, right? So let's take a look at this example. So they measured S&P 500 at the beginning of 2012, and S&P 500 at the time was 1,350, and expected EPS, earnings per share, next period, right, at time t plus 1 is $93 on S&P 500 portfolio. Now, so S&P 500 is only an index number. It's not really the uh, dollar value, but how do they come to the dollar value? Well, so it's weighted average. S&P 500 is weighted average, right? Uh, so if you have uh, basically it comes from all earnings per share forecast of these 500 companies. But then you weight it by exactly the weight of these companies in S&P 500. So the weighted average of their earnings per share forecast comes to $93, right? And yield to maturity on the 10-year note is 3.1%. And the spread between S&P 500 earnings yield and yield to 10-year Treasury yield to maturity is 2.9% at the beginning of 2012. Okay. We pose it and approximate this from the data. So that's called, yield spread, right? Okay. Yield spread from the, empirical, data, historical. Okay, yield spread. So then, earnings, and based on historical data that has been, okay, so uh, earnings yield of S&P 500 uh, can be easily, calculated by, um, 10-year note, treasury note, yield to maturity plus yield spread, which comes to 6%. Okay, so if think about it, um, if earnings yield is 6%, that means the reciprocal, which is the price earnings ratio, will be 1 over 0.06, which will come to 16.67. Okay, that's the P. And once we know the P ratio, then price will be what? P ratio times earnings per share, right? So 1 year later. 1 year later means from the beginning to the end, there will be 1 year later, or this will be the same thing as beginning of 2013, right? It's the same thing as beginning of 2013, and it will be 1 year, right? That's end, which is the same thing as beginning of 2013. So expected S&P 500. This is like price now, right? Because market index is like prices. That's analogy, right? This would be a good analogy. Um, so which is like P sub time T plus 1. Okay, and then P ratio times earnings per share, and we have earnings per share, P ratio, and then it comes to, right, 1,550. Okay, so this is the forecast of, um, S&P 500 market index 1 year later. And rate of return then on S&P 500 is, of course, PT plus 1 minus PT over PT, right? So S&P 500 at the end of 2012 minus S&P 500. So let me the whole thing. What? Okay, it will take time. So you get the idea, right? This is like PT plus 1 minus PT. Over PT, right? And then, therefore, so it's very, logically, it's very simple. Um, so uh, we have, projected uh, S&P 500 rate of return, right? Return on S&P 500 uh, uh, over 1 year period, right? Um, well, some analysts use aggregate, discounted cash flow model or dividend, discount model. Yeah, this will be kind of more, this will be a bit, more complex. But we know, just like, a free cash flow model, right? Uh, but then we will need to generate more forecast, right? More forecast. Uh, but using P ratio, it will be rather simple and a good approximation, right? It will be a good approximation. So here are some, first of all, treasury yield is we have taken that data, right? This isn't our forecast. We already took the forecast. Earnings yield is it's the combination of so this is primary data, and we have always pessimistic scenario, most likely scenario, optimistic scenario, and then we picked most likely scenario. But look, this is the earnings yield. This is the result of 3.1% treasury yield and the yield spread, right, between the two, right? And then, resulting P ratio. Yes, we got that. So this is basically a most likely scenario, right? And then earnings per share forecast, earnings per share forecast. This, as I said, is probably uh, the most complex part. I mean, this is very this is not a complex forecasting model, but in this model, this would be probably um, the most complex part because I said it's weighted average, right? S&P 500 is weighted average, so from all these 500 companies, uh, get the earnings forecast from EPS forecast of all these 500 companies, and then exactly weight them by multiply them by exactly the same weights in that they are taking in S&P 500, right? So this part not difficult, just tedious, right? If you were to do it, and then S&P 500 forecast, generated in the most likely, scenario using that P multiple. Okay, so that's it. That wraps up everything about the equity valuation. And we have uh, um, so we have some time left because the video is always about 30 minutes, and I guess we have done only about assessment 20 minutes. So I wanna show you how to. I mean, um, some time ago there was a when we did spreadsheet 13.2, there was name range. There was a part where they name the variables, and I mean, normally I don't use that. I use soft coding. Of course, name range is also soft coding, but I'm just trying to show you how to do that. It's not that difficult. So uh, let me just stop sharing this and go to new application. Okay, there you go. And I hope you see this Excel file. Not yet, but about now. Yes, you see this Excel file, right? All righty. So here, I made okay. So let me delete this. So let me delete this. Now, what did I do here? So first thing I did was, you can tell this is discounting model, right? Finding price at time t when price at time t plus one, and dividend at time t plus one is given, and then when discount rate is given. It's the same model. Whether I use I simply change the subscript to P0 and P1, dividend at 1, and cost of equity, which is simply the label, and it's the same thing. And okay, so um, what did I do here? So normally you would expect, I would, okay, I will, to find PT, normally I will, enter the cell reference, and then, divide by uh, 1 plus, and I will have to, why isn't it clicking? It's my mouse, okay. And to see, when I did that, it's automatically, entering something like that, right? And then I raise it to T, right? And then normally I will have to lock this because I don't have, if I want to drag it down, I will lock this, right? I will lock that because there are no data points. There are no data points below the row 2. So I cannot just drag it down, because if I drag it down, then it's going to be C3, I mean D3, D4, where there is no data, right? So I would normally lock it, right, into D2. But in this case, I don't have to, right? And I can just drag it down, and it's going to be, right, always pointing to the same cell, right? Although the other, you know, elements, other variables are changing, right? So if I don't want to do it like this, how would I want to do that? I have already using, if you go to formula and define, create from selection. No, I would define, I first use define name. Okay, define name. So and usually, I should build this from the scratch. Then, it would look very, obvious. Um, the range will be, I call this PT, right? And then uh, uh, I set the range, right? Like that. Okay. And then also, okay, I click, select that. Normally, it's gonna automatically pick the name. The name will be, it should normally, if you type in, PT plus one, it's not gonna take it. It's gonna be automatically here. It will take it as, PT underscore one. Okay, but let's try. It says, syntax error because, so this should be underscore, And here it already exists because I have already used it. So here's the thing with the name range, command. If you have already used some label, you cannot reuse it. I mean, this label applies to only this set of data in this table. So if I want to do a different one, and I mean, this is still, let's say, if it is 100, suppose, these are all different, right? Different data. But, it's still PT plus one, and this is DT plus one. So you think, and this is still R, so you think, oh, I'm going to use the, I'm going to, continue to use that label. Well, it's not going to work because this is a new table. Excel considers this as a different data set. In other words, a different problem set. So for different problem set or different data set, Excel wants different names, right? So that's the problem. So I had to change the names to, like this. And that's the downside of it. So, so here, what you need to do here is, if you just, you'll assign that name, right? PT one. This is usually not like this. I would so basically, I entered it like I enter formula like that, PT and underscore one, right? And it's already, so means, there's a data range, right? Plus et underscore. And you don't even have to start with, uppercase, lowercase or uppercase. It all takes, there you go. And then divide it by 1 plus r, and you have to, that r underscore, that's the range, right? But the range is only a single cell in this case, and then raised to. And also this one was, this range was named t, so raised to t, it knows, right? And hit enter, and once you hit enter, I typed 1 plus 1, what? Oh, I forgot to put the, that's the reason. Now, if you hit enter, see, it's not multiple values, so we spill them into the neighboring blank cells. Yeah, basically the same formula, right? And we have the range, so it automatically, takes care of that, right? The whole range is, simultaneously worked out. Whole range that is, named, right? These labels will automatically be, top. Here, all I need to do is, again, P1. There's P1, right? Plus B1. That's the B1, right? Over 1 plus KE, right? Raised to T. Okay, and hit enter, right? It's doing that automatically, right? Now, so this is how you do the name range thing, but it's sometimes it's annoying. Why? Because when you create a new table of just like this, every time you have to rename the labels. You cannot keep if I don't use if I simply use cell reference, right? Uh, if I simply use cell reference, and this one is already named, so I cannot. Let me try to make it like it's already a cell reference. So let me try. I can also do it C2, and then in the case I will have to lock it, right? I will have to lock it. Hit F4 and I'm gonna hit F4. Okay, then lock it, and then yes, and then you drag it down. And you can do it even, and here, I'll just, delete everything here. And you can keep doing this. And here, something needs to be adjusted. Has to be. Right? What is wrong? Something's not right. B2, C2, 1 plus, oh, that's not C, I'm D. And if you do it this way, of course, I will have to make it point to that and then drag it down. Okay. So in other words, with a single label, the same, single label, I mean, a row of a single row of labels, it's not dependent on the labels, right? The name of the variables. The formula is, basically, directly pointing to the data, the cells that contain the data. So you can just you can just copy and drag it down. But then once you use the name range, you can't do that. You will have to and one more thing. If I go to see managing name manager, you see how many variables have been used in this entire. It's not just this. This is spread. Remember this spreadsheet 13-2 exercise. Well, it's the whole workbook. Not just this single worksheet. Whatever you used in this single worksheet, the labels that you used in this single worksheet cannot be reused here. You want to use the same name, but if you, as I said, the same one label for one variable only. So even if it is the problem of the same pattern, so you would have the same variables but different data. But if you are doing it in another area of the same spreadsheet, same worksheet, or if you do it in another worksheet, then you can't use the same label. You have to create new labels, So it's a whole, chaos. If you have a large model, the naming is such a huge, chaos. So I personally don't like it. Okay. Well, it's been like almost 40 minutes. This is a very long video, so I'm gonna have to stop this video, cut this video, and I will see you in the new topic in the next video. Thank you for watching. Signing off.